Section 21, Real Estate Specialty Areas.
Advantages of investing in real estate. The leverage enabled using borrowed money. The possibility of an above-average rate of return. Greater control than ownership of securities. Tax benefits in certain situations. Income, which is cash flow production. Possibility of property appreciation. The disadvantages: high cost to acquire, lack of liquidity, need for active management or hiring a professional property manager, and a high degree of risk. The cash flow of income property, the amount remaining after all the expenses have been paid, tends to make it the safest form of real estate investment. Rent paid by tenants is a major source of property income and depends on the property's location, physical appearance, and available amenities. But when the rent doesn't cover the property expense, negative cash flow results. Pyramiding is a method of using the ownership of one property to drive the acquisition of additional properties. In pyramiding through selling, the investor acquires property, improves it for resale at substantially a higher price, and then uses the profit from the sale to purchase another property. In pyramiding through refinancing, the investor uses the refinance proceeds of one property to purchase new properties. The tax benefits of owning an investment real estate can depend on the current tax law. Capital gain is the difference between the adjusted cost basis of a property and its net selling price, and it may be taxed at a more favorable rate than the taxpayer's earned income. Adjusted cost basis is the investor's acquisition cost, plus the cost of any physical improvements made to the property, and less the amount of any depreciation claimed as a tax deduction. Depreciation, cost recovery, allows an investor to recover the cost of an income-producing asset through tax deductions over the asset's useful life. Losses from the sale of a real estate investment may be deductible. Tax credits are available for renovation of older buildings, low-income housing projects, and historical properties. Exchanges offer investors the opportunity to defer the payment of taxes on profit indefinitely. Property may be exchanged for other like-kind property. The property owner is taxed only on the additional capital or property received as part of the exchange, which is referred to as the boot. Tax is not eliminated, it is deferred, with the capital gain taxed on the eventual sale. A real estate investment syndicate, that's a business venture where participants pool resources to own or develop property. Pooling of the funds may involve securities registration under federal and state security laws. A real estate investment trust does not pay corporate income tax as long as 90% of its income is distributed to its shareholders and other conditions are met. Restrictions and regulations on the formation and operation of a real estate investment trust are very complex. A real estate mortgage investment conduit has qualification, transfer, and liquidation rules. It is notable because of the asset test requirement.